Joining today's ShareCafe ASX Hidden Gems webinar. I'm David Tasker and I'll be filling in for regular host Tim McGowan, who is currently on a plane, half his luck. I'm lucky to be filling in today as once again, the combined ShareCafe Financial News Network's teams have trawled through the ASX to find some cracking companies to present to you today. While you may be tuning in to listen to one or two of these companies, what we find is it's the ones you don't know about that you can generally get the surprise from the most. So I urge you, listen closely to each of the presentations, add them to your watch list and see what they do over the next 3 to 6 months. Remember, this is an interactive webinar, meaning you have the opportunity to ask questions of the presenters. So if you have a question, write it in the Q&A box on the screen and I will put it to the presenter at the end of the presentation. Now, onto the presentations themselves. First up, we have Terra Uranium, ASX code T92, market cap 12 million or so. Terra Uranium is building on a strategic position in the premier Athabasca Basin in Canada, which contains the world's largest and highest grade uranium deposits. Presenting today is Andrew Vigar, Executive Chairman. Andrew, over to you.
Good afternoon, everybody. And I'd like to introduce you to Terra Uranium. We're a new company. We only listed on the ASX on the 8th of September this year, and we're already up and running with an extensive exploration program in the Athabasca. That's in Canada. I'll give you a little bit of background, not only in our company, but also on the nuclear market and how things are going. I guess we should start with a little disclaimer. Everybody should read these and follow them away. Next slide, please. Yep, right, you've all read that. Great, we'll go on to the next one. A little bit on the nuclear industry for those who aren't familiar with it. There's been an enormous change. Myself and my team have been in uranium companies for over 10 years now, and we've seen an enormous change. And I guess it's that people are realizing that if you need baseload power, you need nuclear as some component of the system. And there's been a recognition now by governments all around the world that this is the case, particularly Europe and North America, and we're positioned in North America. Next slide, please. This we borrowed this from Visual Capitalist, and I particularly like this slide because it gives you basically the history of the nuclear industry right back to the 1950s. And the bottom chart there shows you the way that it's changed or grown with time. And we had a major inflection point around 1990, which was the collapse of the previous Soviet Union. And above that, you've got a cross-section of the Athabasca Basin showing the discovery history. And two of the largest deposits, which are Cigar Lake and MacArthur, which are a little bit deeper, were both found in that period around the 1980s into 1990. And really since then, most of the discoveries have been very small, or they've been outside the basin itself, such as the recent Arrow deposit of NextGen. We see that also the major producers in the world has changed. Australia continues to be a major producer through South Australia, but that's as a byproduct. And then we have Canada and Kazakhstan. Kazakhstan, of course, is not part of Russia these days, but is heavily impacted by the sanctions as a lot of their services and exports go through Russia. So they're heavily impacted. So that's a little bit of background on the industry. If we go to the next slide, we'll have a look at what we're doing. So we're focused on, as a company, Terra is focused on looking for these very large bot deposits a little bit deeper in the basin. How we do that is it's people. It's always people. You've got to have the best people. Funding, we're just listed. We've got the funds for that. Finding the right targets and the tools. And I'll run you through a little bit of how we look under deep cover for major uranium deposits. That little bar chart at the top emphasizes in red there, it's drilling. At some point, you do have to drill these things. That's when you make a discovery. That's when you get a major uplift in value. If we just look at the next slide, that'll show us a little bit of a 101 on uranium deposits in the Athabasca. What really stands out there is that these are the richest deposits in the world by order of magnitude. They're extremely high grades. Deposits like MacArthur and Cigar, the core deposits are measured in percents, and not just 1 or 2. We're talking 10 or 20 or 30% uranium. That's just absolutely unheard of. There's an unusual geology here. We have a major thick sandstone unit sitting over a basement, an Archean basement, and major faults where the mineralization is moving. And we have a redox reaction right at that boundary between the sandstone and the basement, often catalyzed by a carbonaceous material in the basement faults. But you can see those little red deposits there right at the unconformity. They're the ones we're looking for. Right, if I just go on to the next slide, that'll show us what we've got. So all the major past deposits are sitting on the right-hand side there, running down just on the outside of inside the basin and just outside it. We identified the Cable Bay Shear Zone, which has been known about since the 60s and 70s, if you remember that earlier slide. This is a major structural zone with known uranium, but there hasn't been a lot of exploration done there since that change in the 1990s because it was considered a little bit too deep. We're looking at depths there of 250, our shallowest at OreCorp, but most of them around the 800-900 metre mark. I guess the big change that's happened there is that we are now moving to solution mining, which is where we actually extract the uranium by dissolving it, similar to the shallower ISR deposits. That means that if we find a deposit under deeper cover, we definitely can extract it. We searched through the database. Our CEO Canada, Mike McClelland, has worked in this area for the last 10 years. He knows every deposit, and we focused straight in on these areas. We have almost 1,000 square kilometres of tenements in our own name. We're not in joint ventures. These are not earn-ins. These are 100% owned by Terra, and we don't have any royalties or offtakes. We find something here, it's ours 100%. I'll quickly run through our major targets. If we go on to the next one, I'll give you a quick run through of what we've done. So we're only listed in September, so we're in just early December. It's only been 3 months, but this is a very professional team. We've hit the ground running hard. First, we've flown geophysics, ZTEM, which is a deep-seeking electrical method. That little picture there in the center shows you the preliminary results from the ZTEM across our properties. We are getting extremely strong conductors in the basement, so we know there's something down there. We're not quite sure what it is yet, but there's definitely conductors there. We've also done a trial of a process called AEDT from Fleet Geospace in Adelaide in Australia. This is a type of passive seismic. We've just had the preliminary results back. I can't present them here, but they are also very strong. So that's for mapping the basement and helping target us on the right spots. The logistics camp is being permitted, should come through next week. We've had verbal approval. We're just waiting for the paperwork. And the dozers will be building the ice roads. They commence this week. And we'll be ready to get into that program early in the new year. And the tenders for the drilling have already been called. One of the big issues you'll find in areas like this, where this is a very hot exploration area, is getting people and equipment and drill rigs. Very, very hard to get. But of course, with our connections and our board that I'll go through at the end, we're able to achieve that. I'll just run through the projects one by one. Next slide, please. The most southern project is Parker. This was the least known about, but the most intriguing. We had an old megatem anomaly here, which is a very old 1960s airborne electrical method with a big anomaly on it. We've got a Rano immediately to the south of us with some old drill holes with significant uranium numbers in them. And the ZTEM, which we've just flown on the right, is showing that we do have a major conductor there. And we also have some surface signs of uranium in a boulder trail. Very interesting area. It's probably coming up our priority list quite quickly. The second target area is right in the center and is the largest. Next slide, please. This is Passfield Lake. This is the one we started on. We have basically two areas to the east and the west. The little image on the top left is the one we had in our prospectus. So within the last 3 months, we've done the ZTEM on the top right, and we've also done some VTEM, showing some very strong conductors there. Again, we're seeing signs of uranium at surface, very low, but it's there. And we'll certainly be getting into this area. This is the largest, and we also have targets east and west of the lake in this one, and also in the north. And the third target area is right at the northern end of our properties and is the shallowest. This is called OreCorp. This is a very intriguing one because we have a very strong dispersion trail. This whole area, the whole Athabasca, has been heavily glaciated. It's very cold there at the moment. It's currently minus 20. It gets down to minus 40 in the winter. The glaciers do take the tops off these deposits, and we can get radiometric dispersion trails. This is the shallowest, but also has never been flown with geophysics. So we're quite excited to have a look at this one. It'll be the easiest for us to test. Next slide, please. And as I said right at the start, it's all about people. We have assembled an amazing team. These are the guys who put the company together. So for myself, there's Dr. Darryl Clark, ex-Cameco, ex-BHP. Troy Vasoli, very experienced in both mine production and exploration, formerly with NextGen, was developing their major project. Doug Engdale, one of the major contractors in the basis, but also a strong experience in production geology, and Dr. Kylie Prendergast, an extremely successful explorer. We're all geologists, all with a very good track record of discovery. But we should also point out our management team. These are the guys on the ground in Canada. Next slide, please. Headed by Mike McClelland. He's the last 10 years with Cameco, heading up all their exploration in this part of the basin. Nova Taylor and Jules, finance people who, along with me, look after the company. Jennifer Burgess, extremely experienced exploration manager, particularly in very low or subarctic areas. She worked on Rio Tinto's Diavik Diamond project and was partly responsible for that discovery. Kyle Patterson is a geophysicist and Tom is a geochemist. All these guys are in-house. We have our own in-house team who are on the ground. Next slide. And just to finish off, we realise our responsibilities. ESG is very important to us. We have engaged already and are continuing to engage with the First Nations people in Canada, and they are strongly supportive of what we're doing. If you don't have a licence to operate on the ground, you won't be successful. Thank you very much, everybody. And if there are any questions, we can take them, David.
Thanks, Andrew. Great presentation. Certainly hit the ground running since listing only a few months ago. There's some questions come through, a bit of intrigue, I suppose, or not intrigue, but how do you actually assemble a team as strong as this and assets as prospective of this at a time when, you know, it's pretty hard to find good projects, but you've clearly done a good job of that, but also assembled a team that's capable of delivering those projects?
Yeah, good question, David. I guess it comes down to people, as it always does. I was approached by Darryl Clark, who's been a friend of mine for 30 years. He's in Canada. He's an Australian, but he lives in Canada. He said he had this great idea to form a company, so he and I got together, and I immediately said to him, well, I need a guy on the ground in Canada who lives and breathes these things and knows them back to front. That's where Mike came from. Troy and Doug have worked together in the mines, in the uranium mines, knew each other very well. They came in onto the team. And then Kylie's worked with me for the last 10 or 12 years in several of the companies that I've formed. And she's ex-Rio and is a superb explorationist. So it's people, David, pretty much. And then I should put a big shout out to Niv Dagan and the guys at Peak Asset Management, because they put the company together. They ran the IPO for us, absolute brilliant process. And Atomic, I guess, who are running all the back room for us. They're doing the CFO and company secretary.
And once you had the team together, did it make it easy then to find the ground?
To some extent, yes, because Mike and the team knew that they had projects that they'd been busting to have a go at for a very long time. And as we said, they were a little bit deeper in the basin, so people had assumed that they were not mineable. But with the changes in technology, particularly what Denison are doing at Wheeler River, they've now done their first full-scale trial mining of solution mining at a depth of 600 meters below surface. And as you can imagine, uranium, if you've got 30% uranium, and uranium is very soluble, so you can dissolve it, you leave a big void, and it basically self-mines itself. So this is an absolute game changer for looking undercover.
And like you say, the technology advancement has really opened up the opportunities, and here's a classic example of one.
Yeah, I think so. And if you look at analogies in gold, I spent a lot of time in WA. It's, everybody was looking around Kalgoorlie, and then they went out and found Tropicana on a completely different trend, or they found the stuff in the Perth Basin, which nobody was really looking at. It's these parallel trends where you sort of make a little bit of a jump, and then everybody's very wise in hindsight. But when we started assembling this about a year ago, this ground was still available. It's not available now. We completely pegged all around. We've got ISO on one side, we've got Denison, we've got Orano, the French. They're all around us.
And in terms of the next 6 to 12 months, what does the activity flow look like?
It's very, very busy. So we're in the field now. We're building the roads. We'll be putting as much of our budget into the ground, David. We have very low overheads. We put our money into drill holes, geophysics, and geochem to make a discovery. So we're flat out now from now right through until August, September.
Quality team. You've clearly assembled a more than interesting grant package, focused on drilling and exploration, which investors love because it creates news flow and keeps the eyeballs on the stock. So, Andrew, congratulations to everything you and the team have achieved, and we look forward to following the company with interest.
Thank you very much, David. Pleasure.
Next up, we have OreCorp, ASX code ORR, with a market cap of just under $200 million. We welcome Henk Diederichs, MD and CEO, to present today. OreCorp is a development and exploration company with a key focus on their Nyanzaga, apologies if I mispronounced that, gold project in northwest Tanzania. Henk, over to you.
Thank you, David, and thank you for the opportunity to introduce OreCorp and the Nyanzaga project. Please, next slide, which is our disclaimers. These are also available on our website for your further review. We can then move to the Nyanzaga project specifically. We completed our definitive feasibility study in August, so very recently. The DFS delivered a project of significant scale, excellent production profile of almost 250,000 ounces of gold per year for the first 10 years of production, a long life operation, a low all-in sustaining cost of $954 per ounce, a pre-production capital cost of $474 million. Now that includes the concurrent development of an open pit and underground operation, a robust NPV and IRR, short payback period, and a low emissions intensity. Next slide, please. Our key focus at present is the project financing workstream. We are still well funded for our current level of activity. We've appointed Oramed as our debt advisors. We've recently received significant interest from various international banks, African and local Tanzanian banks, well in the excess of our $300 million debt target. We're also in discussions with several credit funds and royalty providers as potential additional sources of funding for the project to ultimately minimize the dilution to our shareholders and to come up with the most suited or best available finance package to take the project forward. Next slide, please. So if we have a quick look at our capital structure, 399 million shares on issued. 63% of the shares are held by our top 20 shareholders. If we have a quick look at those on the right-hand side, we've got Rollerson and Mutual Investments. These are two ultra high net worth individuals in Western Australia. There's Federation Mining, the see-through owner to that is Australian Super. And then a new addition to our shareholding structure is Tim Goyder from the Linetown and Chalice fame. Tim acquired his interest in OreCorp through a recent sale of a block of shares that was held by Wilson Asset Management, which we believed was a non-natural holder who acquired that block of shares through their acquisition of Westos, a investment arm of Euroz Hartleys. So Tim acquired 4% in OreCorp through that transaction. Rollison also increased their shareholding by an additional in the same transaction, and then various of our existing shareholders and several new shareholders participated. So very pleased with that transaction. Next slide, please. We've got an experienced board and management, and specifically in Tanzania, dating back to the early 1990s and mid-1990s through Matt's involvement and Alistair's involvement in various projects respectively, and then myself and Michael Davis from the early 2000s. Next slide, please. So Nyanzaga is located in the northwestern part of Tanzania, 60 kilometers south of a town called Mwanza. That is the second largest city in Tanzania. The project is located in the Lake Victoria goldfields. It is a province of world-class gold endowment, significant producers proximal to Nyanzaga, such as Geita, Bulyanhulu, historically Buzwagi, and then also North Mara to our northeast. Next slide, please. So we now have our two cornerstone licenses in place, being the special mining license that was granted on the 13th of December last year, and also our environmental certificate. The project is very well supported by infrastructure and services. We've got an existing access road from Mwanza that runs past our site, approximately 7 kilometers from Nyanzaga. We've got access to water from Lake Victoria, and then access to the grid power through the Bulyanhulu substation, and we'll access that through a 53-kilometer overhead power line. The power in Tanzania is very competitively priced at 8 cents per kilowatt hour, and the Tanzania grid is deemed a green grid under the EU guidelines, consisting of a combination of hydropower and natural gas. Next slide, please. So we declared the first ever ore reserve for Nyanzaga as part of the DFS, containing 40 million tons at above 2 grams a ton for 2.6 million ounces. We've also then identified further opportunities to extend the life of mine beyond the current 10.7 years in the form of an exploration target as a potential depth extension to the Nyanzaga deposit. And we believe that may contain between 4 and 6 million tons of mineralized material. There's also the opportunity for a fourth stage to the Nyanzaga open pit at the current gold price environment, and that will contain 8 million tons at 1.17 grams per ton. So the combination of those two may increase our mine life by 3 to 5 years. We've also recently announced the drilling results for the Kilimani deposit, which is currently a small oxide deposit 400 meters to the north of Nyanzaga. And that drilling confirmed that the feeder systems to Kilimani remains open at depth and along strike to the north. Next slide, please. So a quick breakdown of our pre-production capital cost estimate. Half of the mining cost relates to the establishment of the open pit mining contractor, and then approximately 12 million tons of pre-strip material required. The balance is for the establishment of the underground operation. The process plant is a 4 million ton per annum, very conventional, well-proven CIL facility, so nothing fancy there. The infrastructure cost includes $30 million for the establishment of that overhead power line and associated substations. And then our owner's cost includes $22 million for the resettlement of the community within our entire SML boundary. Table on the right-hand side provides you with a bit of a breakdown of that attractive all-in sustaining cost of $954 per ounce. Next slide, please. So as I mentioned earlier, the DFS delivered a very attractive production profile. We expect to produce nearly 200,000 ounces of gold in the first year of production. That will then steadily increase to almost 300,000 ounces a year for years 5, 6, and 7. Next slide. Nyanzaga compares very favorably to our peers, both on the reserve grade of +2 grams a ton, and then also on the life of mine annual production, as indicated by the chart on the left. Next slide, please. We do have a strong focus on ESG. We maintain very positive relations with our host community. We've done significant work with our host community, specifically in regards to the resettlement action plan over the past 18 months, and pleased to report that we continue to receive good support from the host community. Our emissions intensity is lower than the average for the gold mining industry, and that will further improve with the construction and commissioning of the Julius Nyerere hydropower station, which will increase the hydro contribution to the national grid from the current 36% to a reported 71%. We will then also investigate further opportunities to reduce our emissions footprint during our design phase and future operational life. Next slide, please. So project financing is scheduled for completion by Q1 2023. We achieve that successfully. We believe early construction works will then commence by mid-2023 for first gold production second half 2025. Next slide, please. We've identified various project upside opportunities. The DFS was costed in an escalated cost environment. We are starting to see some improvement on manufacturing costs, but importantly also lead times, both for manufacturing and logistic lead times and costs. Also, our open pit mining unit cost benchmarks quite high, and we believe there's room for improvement during our binding tender process that's imminent. There's been a recent change in Tanzania, which saw a reduction of 2% or offers a reduction of 2% in the royalty. That equates to approximately $35 per ounce in our all-in sustaining costs. I've already discussed some of our upside opportunities. We're also testing several satellite deposit targets within our SML boundary, and will continue to do so in the coming months and years. Next slide, please. We've seen significant political change in Tanzania over the past 18 months, more specifically since the commencement of Her Excellency Samia Suluhu Hassan as president in March 2021. She immediately reached out to the international community, her neighbors, and since then we've seen a significant influx of international investment through the likes of BHP, Barrick, Kabanga Nickel, Total Energies on the East African crude oil pipeline, and more recently the detailed negotiations between Shell and the government of Tanzania on a multi-billion-dollar LNG project. Next slide, please. So just in summary, Nyanzaga offers an excellent project, long life, strong production profile, high margin. There's significant interest from various financial institutions to assist in the funding of the project. We believe we are very undervalued compared to our peers, and we look forward to be the first new gold mine in Tanzania for over 15 years. Thank you, David. Over to you.
Thanks, Henk. Great presentation. Clearly a robust project. I just wanted to step back a little bit on the macro, and you did touch on it. Tanzania itself, from a historical exploration development point of view, has probably been beaten up a little bit due to historical reasons. How have you seen the changes in the recent years? And you did touch on it in your last slide, but how have you practically and operationally seen the changes? And that obviously gives you the confidence and the excitement about developing this project.
Yeah, you're absolutely right, David. Historically, Tanzania used to be a very favorable investment destination for the international investors. It went through a couple of years of very testing times, from 2017 to early 2021. That change then happened through the appointment of Her Excellency. We saw significant change on macro level from very early on. It took a little bit longer for that to then filter through the various government institutions. And we are pleased to report that we see continued improvement in our engagement. So where 18 months ago, it was very difficult to discuss any obstacles that investors may face, there's now a genuine drive and desire to better understand these obstacles, to remove those or address those, to ultimately secure the international investors. So significantly positive change over the several months.
And for a company such as yours, there's sort of a stick with it approach. It's you believe in the project, so you've got to commit to the process. And while, like you say, there were a couple of tough years, it was all about continuing the process and working with government and the relevant bodies to ensure that as you got to this stage, that the tide may have turned in terms of the macro.
Yeah, absolutely. And look, that is critical to maintain those positive relations and to demonstrate that you try to do the right thing and that you work closely with your host communities and host government to ultimately derive a result that's in best interest of all parties involved. And that's paid off in our case.
Yeah, look, and you did mention early in your presentation, people do forget that Tanzania has a very strong mining focused and resource exploration and development focused country. So the skill sets within country are immense and can clearly be applied to this project.
Yeah, absolutely. And a long mining history dating back to the mid-1990s. So we're now well into the second generation of miners within Tanzania. So very good pool of skills available, which is a big positive for us as a project.
And clearly nothing's been announced, so I don't want you to break any news here today, but discussions with financiers, how are they progressing?
Yeah, very well. Lots of interest from banks in particular, but also from PE groups, royalty groups, and the likes. So again, if we rewind 18 months ago, the interest from the banks were minimal, if not non-existent. Fast forward 18 months, that's exactly the opposite, fortunately. Not a lot of good projects for these financial institutions on the African continent to deploy their funds to. And that's really where Nyanzaga presents a unique opportunity, not only to our investors, but also to these financial institutions.
Congratulations, Henk and the team for sticking with it, committing to Tanzania and doubling down on the project at what would have been a very tough time, but you're clearly reaping the benefits now of the hard work that's gone in over many years. So look forward to following the company and the project development with interest over the next certainly 6 to 12 months as you lock in financing and move towards production. So Henk, congratulations, and we look forward to hearing from you again soon.
Thank you, David. Much appreciated. And thank you all for your participation in this presentation. Perfect.
Next up, we have Genetic Signatures, ASX code GSS, market cap of about $119 million. Genetic Signatures is a specialist molecular diagnostics company focused on the development and commercialization of its proprietary platform technology, 3Base. We welcome John Melki, CEO and Director, who will present on behalf of the company today. John, over to you.
Thanks so much, David. Something a little different, and for those that are new to the story, I can give you a brief introduction while our disclaimer's on the next slide. But Genetic Signatures is a diagnostic company. We're focused on the better detection of infectious diseases. So the reason we do this are infectious diseases are a leading cause of death. They could be bacterial, they could be viral, protozoal, fungal. In fact, we know that antibiotic-resistant bacteria it can cause almost 10 deaths every minute around the globe. So better diagnostics ultimately save lives. So we invented a technology, pre-based technology, which does enable the better detection of infectious diseases. So the technology itself dramatically simplifies the detection of these bugs, these pathogens, and multiple pathogens from the same patient sample, which is often called multiplex. So we use our technology to make molecular or their PCR-based tests, and these tests identify infectious diseases from clinical samples. We sell these in kit form. It's under the Easy Screen mark, and we sell them to pathology labs who run our tests. They're ultimately reimbursed by government programs, and the kits are low cost, rapid, and they allow accurate detection of infectious diseases. So the technology has been around for a while. We have had strong commercial adoption in Australia, but we know that that's 1 to 2% of the world market. So we're currently focused on expansion into Europe and into the US, which represent over 70% of the global market. We have 4 test kits that are cleared for sale. We have more kits coming through the development pathway, and these kits are what generate our revenue. So last financial year was a record for us, 35 million in sales, cash flow positive and profitable. So we're now in a great position, having multiple drivers for growth, and this includes that expansion into those bigger offshore markets. We have new products coming through to commercial release, and we have instrument expansion, which enables us to embed our free-based technology into our customer labs. So that allows them to take on new tests as we release them. So we think of our instruments as the printer in the printer and cartridge model, and our test kits being the ink or the cartridge. So importantly, we've increased our instrument placement by over 4-fold in the last 2 to 3 years. So the next slide is our company snapshot. Say we have a market cap of around 115 million, and almost 30% of that is in cash. So this may well be the reason for the recent research reports that you can see on the right there, with target prices which are much higher than where we're currently trading. Our top shareholders include Chris Abbott from Maple Brown Abbott, who was a co-founder of the company, and we also have Fidelity and Perennial as supporters on our register. So the next slide shows our revenue growth for the last 4 years and the most recent quarter, and you can see that 4-year CAGR of 89%. So the most recent quarter is the last bar there. Remember, it's only a quarter; the rest are annual, and that was 16% higher than the preceding quarter. Our last quarter was, in context, is higher than the entire FY19 revenue in just the first 3 months of this financial year. So that correlates with that 4-fold increase in instruments that I mentioned earlier. So the other points I would like to make here is that there is certainly a growing contribution from offshore revenue, and these include non-COVID kits. So we're actually now in a transition phase, shifting from doing COVID-only testing, some customers doing only COVID-only, to full screening, full respiratory panel screening. And these are the customers that came on over the last few years. So on the next slide, I would like to briefly describe our free-based technology because it is unique to us. We're obviously very proud of it. And this slide hopefully will make sense. What we're seeing there are 3 sequences from an actual virus, human papilloma virus. And the sequence is just the DNA alphabet, A, C, G, or T. What we know is that the most common mutation in nature in DNA is a C letter changing to a T letter. And in some cases, that comprises over 90% of the mutations that we see. And these are what cause the emergence of variants and changes within the organisms. So our scientists thought if we were able to force that change in all sequences, then we would be much better able to detect variants much more efficiently. So FreeBase was born, and it's been developed for over 10 years. And you can see in those 3 sequences here that there's one variant of HPV that has 2 Cs, the middle variant has no Cs, the bottom variant has only 1 C. So by us forcing that C to T change, we end up with just one sequence, which allows us to detect all 3 variants. of HPV. So you can see that this technology lends itself to detecting multiple organisms in one test. And the next slide will show how we apply that to the syndromic testing field. Because syndromic testing is the future of pathology testing. It just simply refers to the ability of a test to detect multiple organisms from the same clinical samples when symptoms are present. So we're all familiar with the symptoms of respiratory or gastroenteritis, and this syndromic approach allows us to make panels that are relevant to those conditions. So we have developed assays for over 100 organisms, and we can combine them in those clinically relevant panels. So, and that allows more information to be reported to the doctors in a very rapid amount of time. So the next slide will just show you what our syndromic panels look like. These are panels or kits that we have in the market at the moment. The key here is that our revenue was predominantly from those top two products. So that's the respiratory and the gastrointestinal products that we produce. But obviously we're very excited because we have many more kits that are coming through that development pathway. So all of these will be either are or will be revenue generating. So in terms of regulatory approvals, we have 4 kits with clearances in 1 or more jurisdictions. And in terms of the US, we've actually identified an unmet need for enteric protozoan testing. And I'd like to tell you a little bit more about that on the next slide. So traditional testing for enteric protozoan, it requires skilled labor and a microscope. They need to look down at stool samples that have been prepared on a slide. It's not very sensitive. Results can take more than a week to report. And the reimbursement levels to the lab are quite low. They're $10 to $20. But these tests persist despite that, as there is no molecular test that has a broad enough coverage to replace that traditional test. And so we identified that we can get coverage with about 8 molecular targets where others only have 3. And this molecular test that we've developed is at the end of the clinical trial process before submission to the FDA. So this test will take hours. It's highly sensitive. It has a reimbursement code already in place of almost $263 US. So our customers, those labs, are able to change from the test that loses money, that takes a long time and is insensitive, to one of ours, which is highly sensitive, rapid, and it can become a profit center for those labs. So the next slide summarizes the growth initiatives that we are working on. It should be clear, I guess, from what I've said so far, is that we're really well primed now to leverage our experience in Australia and to grow that into those international markets that we're targeting. We're already operating in Europe, in the UK, in Germany, in Greece, and we're focused now on driving adoption of more free-based products. The US, I've described that opportunity, and that will allow us to build a free-based franchise once that protozoan detection kit is cleared. We're focused on building and expanding our EasyScreen products. They are revenue generating, as I said, and develop those kits and get regulatory clearances, which will allow us to sell these freely into multiple markets. So embedding the free-based technology is certainly an aim of ours. It's a high-value customer workflow. It allows the adoption of our EasyScreen kits for more applications as we release new products. I did also want to talk just for a minute on a next generation sample to result instrument. This is, as I said, the instruments are our printer in that model. And we are actually announced that we are investing heavily into a next generation sample to result instrument. So this just means that the technician in the lab can just put a primary sample into our instrument. It will do the 3-base conversion, purify, amplify, and report results back. So very hands off, and we do think this will be a game changer with our customers. So I'll just wrap up on the next slide, which is just our upcoming milestone. So obviously I've described that US enteric protozoan opportunity. So filing that application is obviously something that we're working very hard on. We're close, and we expect to file that in the coming months. Increasing sales and presence, obviously, in those target markets that we're after. We're not relying on one US FDA product, we're relying on multiple, and that second one has actually already commenced. We just haven't announced to the market yet what that product is, and obviously continual investment into our technology. So I'm happy to pause there if there are any questions, David.
Thanks, John. Great presentation. Some people may say, and serendipity is a great thing, that the right place, right time, but a lot of work went into developing this technology pre-COVID, and the business was already up and running and commercializing product as COVID started to take hold. So this is certainly not a COVID story. This was a company that had built a technology that was able to move quickly when COVID and the various screening and analysis requirements came in. So just to step back a little bit, the work that was done pre-COVID, just to talk through that a little bit for those who are watching.
Yeah, sure, David. It's a really good question, because I think sometimes just put into that COVID camp, which we've been developing three-base technology for well over 10 years. It's a technology that we had put into syndromic testing well before the pandemic. So we had already commercialized the gastrointestinal test, so it looks for stomach bugs, and the respiratory multiplex screening before the pandemic. And the respiratory kit actually detected the known coronaviruses at that time. So as you suggested, it was quite an easy pivot for us when the new coronavirus came, just to change our test slightly in order to specifically pick up that one variant. So we see this now really is going back to our core business. So we have the teams in place in the US, we have teams in place in Europe who are actively promoting, selling three-base products. And that's what I meant earlier when I said we've got customers who've come on with just COVID-only testing who are now transitioning to full respiratory screening. And we've also had customers who have said, what about your enteric test? We'd love to try that, because all of our tests work in virtually exactly the same way.
And just touching on that, there is a question here about COVID revenue. So a lot of businesses that had screening or testing tools for COVID saw a significant uplift in revenue, but clearly that's not where the revenue sort of rump sits. That was a great foundation and a great opportunity. But as you say, the question here is, did it open the doors for everything else, which creates the next revenue opportunity?
That's exactly correct, David. So that it really was an opportunity for us. We were in a very good position to leverage it. We quadrupled the instruments we have in the field really on the back of that. And that was primarily overseas in Europe. We also had labs in the US testing for COVID at that time. So it was a great opportunity to get our instruments, our printers out there into customer labs. And that's why now we're transitioning back to what was our core business. So while we may have fewer samples going through, we're looking for more targets in those same samples. So it's higher value per patient sample. So we're really in a great position to leverage off that with new products coming through, opening the US market for us. So we're very excited.
And just talking about the US market, the three-base franchise model, how does that work in practicality, and how big is the opportunity?
The opportunity is large. I didn't go through it in those 10 minutes, but we've done some modeling with a 263 US-based reimbursement that goes to the lab, not to us. You can see that opportunity. The slide said there are 5.5 million tests of these done every year in the US. And because it's an unmet need, we've said we're targeting up to 40% of that market. And then we've modeled either $20, $30, $40 US, which is conservative given the rebate. And that translates to between 22 and 88 million US dollars in annual revenue. In terms of embedding the three-base technology in that franchise, the second product is already, as I said, starting their clinical trial for that next product, which will work on the same equipment, which allows the labs to consolidate all the tests that they would like to use on the one platform. So it's really what we're seeing in Australia and Europe, that once that platform's in, we can just feed it with any number of tests as quickly as we can get them out and get regulatory clearance for them.
Thanks, John. Great presentation. A well-developed company with a significant opportunity to expand. We look forward to following the expansion of the company and its product range into next year and beyond. And all the best for Christmas.
You too, David. Thanks so much.
Last but by no means least, we have Splitit, ASX code SPT, market cap of a touch over $100 million, 103 to be exact. Splitit aims to be the leading provider of card-based instalment payment solutions for merchants and shoppers worldwide. Presenting today is CFO Ben Malone. Ben, over to you.
Thank you, David. So hello and thank you for joining me today. My name's Ben Malone. I'm the CFO at Splitit Payments Limited. And if we can just skip over to slide 3, past the disclaimer, which you can all read in your own time. So who is Splitit? We're a white label instalments as a service platform, and I'll explain with some visuals in a few slides a bit more what I mean by that. But unlike consumer lend-in, buy now, pay later players, we're a technology company. Our instalments technology utilizes a shopper's existing credit card balance. So in simple terms, that means that we use the credit that you've already earned on your card to secure or hold the full balance of the purchase. And then we charge a monthly installment in time as we reduce that hold down. So for a consumer, they're driving the credit that they've already earned further. For a merchant, they retain ownership of the customer relationship by offering their own white labeled solution. And for Splitit, our technology ensures a near zero loss rate given the full transaction value secured. And our white label offering ensures a very low and scalable cost base given we're not marketing to or acquiring consumers. Our IP is patent protected. Our largest market is the US, and most of our commercial operations are focused there. And we were founded in Israel. To the right of screen, you can see some of our current customers. And just this week, actually, we announced the expansion of our relationship with the Google Store. Initially, that relationship was in Japan, where we signed up in 2021. And then just this week, we announced the expansion into new regions in the US, Canada, and here in Australia, which was a real major milestone for us and very exciting. So we'll move on to the next slide, please. So this one's somewhat of a recap of the previous, but Splitit provides a technology platform empowering merchants to offer instalment payments embedded within their own customer journey. We're the only instalment payment solution allowing shoppers to use their existing credit card at checkout without increasing their debt. So we're very different, and we offer a very different merchant and consumer value proposition to others in the market. Moving on, please. Now, I mentioned white label a few times, so I'll show you what I mean by that here. So unlike a traditional buy now, pay later, you won't see Splitit competing for real estate with the sort of plethora of other consumer lending options that we see in the market. As you can see on the left, we're an elegant white labeled solution embedded in the merchant's customer journey. And this is what's allowed us to really break away from what is becoming a pretty crowded space. So we provide the technology and our merchants own the customer relationships. Next slide, please. In terms of the opportunity size, there's over $4 trillion of credit issued on US cards, and 80% of that is generally unutilized at any point in time, which really leaves $3.3 trillion in available credit. And that's really the space that Splitit's playing in. So in the US, this is not a number we're seeing come down in recent years. In fact, quite the opposite. Moving on, please. Now, I've previously mentioned some changes over 2022 in our product and our strategy that's really sort of set us apart from that sort of more crowded BNPL space, and I'll talk a bit more about that here. So to the top left, what we're really saying here is we've identified a fundamental flaw in the legacy model. So, there's soaring write-offs, regulatory scrutiny, high costs of capital, and very high consumer acquisition costs, and that's really challenging a lot of pathways to profitability. So if I sort of counter that with Splitit, we're not exposed to bad debts due to our technology. We do not have the exorbitant acquisition costs due to the white labeled strategy focusing on the merchant. And we're already regulated via the credit card regulations. So we offer a real counter to the norm. To the top right, what we're saying here is the concept of installments, however, really holds true, and it delivers clear value, higher conversion and higher basket sizes or order values. At Splitit, we have over $1,000 is our average order value. So really driving those higher value purchases. And to the bottom of screen, Splitit is driving a next generation BNPL service, a tech offering to empower merchants and the only solution enabling shoppers to utilize their existing credit. Moving on to the next slide, please. Okay, so we'll talk a bit more about some recent accomplishments. Now, I'll start actually in the bottom left of screen on the organisation. It's important to note we hired a new CEO, Nandan Sheth, this year. Nandan came on board in February. So a significant amount of payments experience, most recently at Fiserv, but many years before that in other companies as well. A number of new executives and board members have also been brought on with over 150 years of very deep payments experience. We've also upgraded our client success team, our risk management practices, and really improved client satisfaction. And the headquarters in the US has shifted to Atlanta, which is a real fintech hub within the US. Financially, we've the real focus on the white label strategy and away from the consumer has enabled us to cut our operating cost run rate by $10 million per annum. So really slowed down the burn there and supported a pathway to profitability, as has our improved transaction margins, now up to 1.4%, which is a 3.5 times improvement. We'll grow our merchant sales volume, our transaction volume in 2022 by around 10%, and that's in a transitionary year with a large pivot in strategy. And at the same time, we've reduced our cost of capital with Goldman Sachs by 100 basis points as well. From a product perspective, I've mentioned the white label offering, the installments as a service, so that's been a real shift this year. We've also delivered a new processing platform, and that's reduced a lot of friction for merchants. And we've launched a lot of new flexible payment plans. So Splitit has always had two options. In one option, for the consumer, the product works the same. However, from the merchant's perspective, one option that will fund the merchant up front if they so choose. Obviously, that's where the Goldman Sachs credit line comes from. In the other scenario, the merchant may be happy to, front the working capital themselves and really just want Splitit for the processing. So that's obviously a lower fee for the merchant. So that also minimises our interest rate exposure. But adding to that this year, we've also added a lot of new plans offering a variation in terms of upfront deposits and things like that, and different cadence of instalments. And from a sales perspective, we've also rebuilt our sales team under a new chief revenue officer who's ex-Visa. We have over $500 million in pipeline at the moment. We've also closed around $100 million in annualized MSV that will start coming to fruition in the next couple of quarters, and signed a number of new partnerships with the likes of Blue Snap, Everywhere, and Checkout.com. So moving on, please. Okay, so this is just recapping a little more on some of the financial progress. We spoke a bit about this in the previous, so I won't spend too much time, but higher margins really has been due to a focus on the secured credit purchases and efficient funding. We also have a lot less exposure to interest rates due to our the fact that 40% of our business is on that non-funded model that I spoke about. We've also had a large drop in OPEX, which I've mentioned before, due to the strategic pivots that's been made, and we have a very large pipelines, around $2 to $4 billion US of transaction volume in our sort of multi-year pipeline over the next 3 years, and we see that as pushing towards $28 to $56 million of transaction margin based on our current rates. So we'll move over, please. So this slide is just providing a visual on the cost-based efficiencies, again, compared to that sort of more traditional or legacy BNPL model. So you can see with minimal consumer acquisition costs, regulatory costs, and bad debts, the current Splitit being in the middle of screen, is already very different to the what we call the sort of more traditional model to the left of screen. And then over time, we see Splitit moving to the right of screen there, which is really breaking away a little further from the funding to a model where issuing banks may fund the transaction. And we'll talk a bit more about that in the next slide, which we can move to now. Okay, so in terms of our strategy, over time, we're centering that around 3 pillars. So number one, our installments as a service, our white label offering. Our conversion rates are industry leading. We drive the highest customer lifetime value for our merchants. Secondly, a one-to-many distribution strategy. So we've signed recent partners such as Blue Snap, Checkout.com, and we have a number of late-stage opportunities with distribution partners and acquirers in the works at the moment. It's important to note these are not just referral partnerships. In many cases, our tech will be actually embedded within their platforms. So it's a very cost-effective go-to-market model. And thirdly, and this is what I was referencing in the previous slide, unlocking issuer installments. So many issuers want to play here, but without an agnostic point of sale solution, their traction's been somewhat limited. But through network partnerships, we can really help unlock this for issuers. So as well as benefiting them, it can push Splitit further away from the funding of the transaction ourselves and towards a model where the issuer funded model is powered by Splitit's technology. Moving on to the next slide, please. So just in terms of some more immediate goals for the company, these really all link back to the previous slide as well. But in 2023, we're aiming to sign 3 large enterprise merchants at a minimum, 2 large new distribution partners, 2 new acquirers, as well as a network partnership. Networks, obviously Visa, MasterCard and the like is what we refer to there. In terms of the status of those, we've made strong progress across all. There's very active conversations in pipeline and many are in very advanced stages at the moment. Ultimately, delivering on those will lead to a significant uplift in our transaction volumes. And then we'll move on to the next one, please. So I can just wrap up at this point in time. So Splitit's really executed a significant pivot, putting us on a clearer path to profitability over time. The early indications are showing the white label platforms driving high conversion and translating into greater revenue per merchant. And our new sales strategy with a highly experienced sales teams driving meaningful pipeline growth with about $500 million there. Our partnership-led strategy is taking shape at the moment. We're really at the table with a lot of large partners, and our focus from this point on is to execute on that $2 to $4 billion merchant sales volume opportunity over the coming years. Thank you very much for your time, and I'll pass back over to David with any questions.
Thanks, Ben. Great presentation. Investors, I think, clearly like companies who have a tech but know when to pivot and know when to read the market and drive itself to where it needs to be from both an operational and a financial point of view. So hats off to you and the team for taking that leap, but also acknowledging what needed to be done to get to where you needed to be. And certainly something worth watching over the coming months as that pivot takes more shape. So congratulations there as a first statement. But a question around the Google deal. Tell us some more about the expansion details and what were the factors that Google considered when deciding whether to expand further?
Yep, good question. So as I mentioned, we first signed up with Google back in 2021, and that originally that was focused on the Japanese market and selling of the Pixel phones. So they're iPhone equivalent, and we saw really good. It was a really good use case for us and them, and it delivered some great results. So what they found is a significant uplift in the amount of in the basket sizes. So they offered 2 sort of phones, a cheaper and a more expensive version. Offering Splitit, they were seeing a significant uplift in the amount of consumers that were going onto the higher one or adding more to the basket. So this year they added another product to the mix as well. They added the watch, and then sort of due to all the success that we had there, it really led to geographic expansion. And that's really one of the main benefits of our model, is that it's very globally scalable. So there's a lot of opportunity to win a merchant in a certain market and then scale. And I don't think there's any other buy now, pay laters that can have that global reach. So yeah, the US, Canada and Australia are the latest ones. I'd expect to see a similar sort of staggered rollout of regions over 2023. Maybe start with one product, add more, and then obviously, from there it can go in many directions.
And do you have any hard or anecdotal evidence of the total basket or the total customer revenue that was being generated out of Japan for those products were being translated or using the Splitit platform?
Yeah, I mean, anecdotally, there was up to sort of 30-40% of transactions going through Splitit at a point in time. So the uptake of the product was very high, and as well, sort of again, this is obviously driven by data from our counterparty, but the amount of uplift in those phones from the cheaper to the more expensive, i.e. the increase in basket size, was quite material.
And do you have any understanding of what the Google Store revenue or the opportunity looks like in the US, Canada and Australia?
Oh, we don't sort of publicly talk about that, but obviously, our Japanese opportunity has sort of been, quite significant, close to sort of 10% of the transaction volumes that the business does. we see the US market being substantially larger, obviously, and Canada and Australia probably slightly smaller than Japan, but still quite sizable as well.
Now, talk about the different products, funded and non-funded. How do they work from an operational point of view, and how much of the business is through each? And do you see that trend continuing, or do you see a shifting in the trend?
Yeah, how they work, I mean, the product itself from a consumer's perspective is identical each time. If you've got a credit card, as long as that merchant accepts Splitit, it'll operate the same way for you. Very, very seamless. But behind the scenes, some merchants will want the funding up front. Some will be happy to pay the lower fees and not take the funding up front. So really, if there is funding, we've got a credit line with Goldman Sachs, a very supportive lender that sits behind that. We would obviously have a cost of funds associated, and we'll charge those merchants more in that instance. The good thing about not having an entire business that's completely dependent on that is we have 40% of our book, so that's the current amount that's not funded, that has no exposure to any sort of interest rates that are going on at the moment. So that's a real advantage. In time, we see a lot of banks and networks that are trying to play in this space and having limited traction. And by partnering with Splitit, potentially they can take more of the funding lift from us, and we can again just sort of use our technology to power them. Primarily, we want to be a tech company, and that's our focus.
Have you been surprised that the BNPL players haven't tried to replicate what you do?
Look, we're patent protected. I think obviously helps. And the business started developing the technology back in Israel some time ago, and there was a number of years in development before sort of going to commercialization. So it is quite complicated behind the scenes. Payments is a really complicated world, and there's upwards of around 100 different payment gateways that we're integrated in. So there's a lot of technical lift that had to go into that. So I think that's probably what's led to our sort of first mover advantage at this stage.
And regulation seems to be a hot topic in the buy now, pay later space. How do you see the current landscape, and what does it mean for Splitit?
Yep, I think the current landscape is heightened regulation, and it's only going to continue that way. You've seen the CFPB regulations in the US. There's been announcements recently here in Australia, and the UK for some time have been very active in this space as well. So all the major sort of markets that many of these buy now pay later players are playing in are coming under a lot more regulatory scrutiny, and I think that's only going to continue. For us, I mean, we really welcome that. It levels the playing field. We're already regulated via the credit card regulations as it is. So given that we're not lending to consumers and we're using the existing credit there, we really welcome more regulation in this space to really level the playing field. So I think it plays to our strengths.
And finally, a lot of talk about new relationships and what it could mean in terms of revenue and margin. These new relationships, how quickly do you think you will see a translation into increased MSV?
Yeah, look, I think that they're going to vary, obviously, but some of them already are, and some of the recent signings are in what I would call an onboarding stage. So there's always a period of time where we need to train the sort of counterparty sales team. We need to work their Splitit's numbers into their own quotas, embed the technology and all those sort of things. But I think within sort of a quarter or two, we should be fully up and operationally when after a new partner's signed. And it can be a sort of a slower ramp maybe in that first quarter and more acceleration once the product's fully embedded.
Being a great story, you have driven, or the team has driven great growth. Importantly, as I said, acknowledged when a pivot was needed, pivoted into the direction that will see the operation and financial benefits going forward. Clearly a business that's built around long-term stable income and strong partnerships. Exciting times ahead. We wish you all the best for the festive season. Look forward to seeing how the pivot rolls out early into the new year.
Thanks very much, David. Great to be here.
Well, thanks everybody. Thanks to the presenters. Thanks for those for jumping in and watching today's presentations. As I said at the beginning, you may have come to watch one company and have uncovered your own hidden gem. Put all the companies on the watch list, see what they're all up to, see if they deliver on the operational outcomes they were looking to achieve over the next 6 to 12 months. Look forward to seeing you next week when Tim will be back, and we'll see you then.